Jonathan Wield. I'm the managing partner of Unbridled Wealth, and we're really excited about tonight. I'm actually really excited because this is primarily going to be Stan Bullis walking us through this presentation and talking about small business banking and specifically the infinite banking concept. And at Unbridled, with the Unbridled Companies, we've been learning a lot the last 2 months, especially around estate planning, business succession, and of course infinite banking over the last 6 to 10 years. And so Stan's going to walk us through some of the strategies we've been paying $500 an hour to learn and create. And hopefully this will add some value to you if you're a small business owner or an entrepreneur. And really our goal of these monthly webinars is to provide financial education and then hopefully provoke some curiosity into this infinite banking concept and how you can utilize it in your business and in your family. So Stan Bullis, the founder of Unbridled, the CEO of Unbridled Companies, is going to be walking us through that. So Stan, you want to take it away?
Sure. Well, hi everybody. It's always hard to talk to a camera.
Yeah, no.
It's much better. One of our core businesses is live events. Up until last year, we did 450 events globally. And so we're live event experts. So when this whole digital revolution came, we had to adjust our speaking style. And so I'm in a room with a whole bunch of different cameras and whiteboard and TV screen. And so,
hey, at least I'm here with you.
That's right. That's right. So today's agenda, I got a couple slides on Unbridled. We're always going to do the banking system fundamentals, talk a little bit about uncommon knowledge. I've got 3 case studies. One you might have seen before, the real estate. The second one, adjacent opportunity, a few people have seen. And then the third case study is a brand new one. And the supposition there is, what if I got hit by a truck tomorrow? What's going to happen with all these policies? Sources and uses, because we get that question a lot, and then we'll land it at the question and answers. And so, most of these were well into the evening with questions. And so don't be bashful, don't hold back. Like I said before, we started Unbridled Solutions originally as an event planning company. And to do events, you've got to have brand development, you've got to have finance, you've got to have people, you have to have facilities and infrastructure, benefits and engagement and IT. And so that quickly became our shared services platform. And we realized that we have a lot of time and expense in that, and that we didn't need to just hold it for our event planning company. So we started looking for adjacent opportunity, which I'll talk about a little later. So out of that, we grew a travel agency, we grew a media company, we grew a production company, we grew a construction company, a call center, wealth management, 501c3, and all of those ride on the same shared service platform. So if you're a small business looking to diversify, I think a big secret is looking at the product next door and managing shared services, because each of these organizations, they pay an hourly rate plus a 35% burden for their shared service. So the shared service platform in a startup has 100% efficacy because they're only buying the time that they're using, which allows them more time to do the things that their mission and their operating agreement is. Along the way, we stumbled on the idea that we needed more office space, and we got lucky and bought this old mansion downtown Denver, 20,000 square feet, called the Grant Street Mansion. And that actually launched a whole new division of Unbridled as adjacent opportunity, and that's to restore these old mansions, restore and occupy them. And then we started getting good at this, so then we started reaching outside of Unbridled and partnering with others. So basically that looks like a VC. The one on the left are companies that we partnered that we may not own the majority of, but all ride on our shared service platform. And the ones on the right of your screen, Fremont, we started expanding into a city, and we'll talk about that a little bit later. And so our vision is that we're a collaboration of destinies, which means that we collect young entrepreneurs, help them discover their lane in a culture of authenticity, and then create business of generosity. Our mission is simply do good by doing well. And so if you look at the 20/20/60, every dollar that we earn in net profit, we give 20% to charity. The second 20% always stays in each of the companies. That second 20% is what powers a lot of these banking systems. And then the balance 60% we distribute out to shareholders. And of course, those are all driven by our values. And our values simply are between character and change is this idea that we collaborate fearlessly. Between change and credibility is we're always creating innovative solutions. So for example, when COVID hit, we pivoted our entire company from a live event platform to a virtual platform. And then between credibility and community is inspiring generosity. Between community and character is cultivating growth with each other. And so those are the fundamentals around Unbridled. And, our give back's close to 800,000 a year. And so collectively, and so we feel like we're doing our mission really well. So in short, when you think about Unbridled, we create businesses with young entrepreneurs. We advance our vision, mission, and values. We own the consolidated shared service function. We restore and occupy historic places. We leverage federal and state tax credits, TIFs, and opportunity zone programs. And then the last thing is what we're talking about today is we use the infinite banking concept or a private banking system to create positive arbitrage and wealth and legacy.
You could sum that all up by saying we keep pretty busy.
Yeah, or you could sum it up by saying the foundation of everything we do is owning the banking function, right?
Yeah.
And so when we started this whole thing, I've been a whole life policy owner, probably for 11 years now. And I didn't start really understanding it till about 7 or 8 years ago when we started applying it. And then I ran into this phrase from Thomas Jefferson from 1809. And he says, hey, if the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks will deprive people of all property until their children wake up homeless on the continent their fathers conquered. The issuing power should be taken from the banks and restored to the people to whom it properly belongs. And so when you're working inside of IBC, you're a partner. It's a mutual company, the ones we use, which means that you're partners in that company, and which means that the banking system is driven by you, and it's your banking system. And so the fulfillment of what, or the antidote or the remedy or the elixir of what he's saying is we believe found in properly structured whole life banks. And so the term private banking system, infinite banking concept, you're going to hear me use both of them. They're interchangeable. Specifically, it's the process of using a properly designed whole life insurance policy as a self-managed private banking system.
And that's a really important distinction when we're talking about this, because if you Google whole life insurance or you've listened to Dave Ramsey or any financial advisor,
right,
they're always saying it's junk. And so this strategy, this system is probably the most important part, is how you design the policy, right?
Yep.
Driving down commissions, raising cash value. And so we're going to get into a lot of that today and probably give you some transparency that you've not seen before in the industry into like how this is designed and how it works, how fees and commissions work. But I just think that's an important distinction when it comes to IBC.
Yep. And you're going to see Jonathan and I kind of back and forth like this because, if it took me 5 years to get it and we're trying to do it in an hour and a half, we have to say the same thing over and over again. So first thing I want you to know, I'm going to try to make it super simple. There's 3 components of a private banking system. It's the life insurance. Second, it's the cash value. Third is the lending. So there's only 3 components of that. And so we're going to start first with the life insurance, right? So first thing you should know is the difference between whole life and term life is that whole life insures you for your whole life, right?
Yeah.
Not term, which insures you for, part-time. So there's a cost of insurance. The second is it's a fixed price for life. So it's like they dollar cost averaged your whole life. And so that basically means that your insurance will appear expensive in the beginning. And then until it's actually free, right? And then at the end, it'll look more expensive as you get older, but it's buried in the fundamentals of the cost. So second, initially it appears expensive, never times out. always grows. And by year 3, it cash flows. And so what does that mean? That means in year 3, the interest earned inside your banking system overcomes the cost of insurance. And so the first thing between, buy term, invest the difference, or whole life, what we want you to know is by year 3, sometimes by year 2, the interest earned inside your bank overthrows and overcomes the cost of the insurance. It can be owned by an individual, it can be owned by a corporation.
Yeah. And this is the distinction as well with design, because when it comes to the way we're designing it, it's even sometimes year 2 that it cash flows. But
Right.
with a typical design policy, it's usually 10, 11 years before it gets to that.
So let's do this. Let me finish these couple slides, and then I'll throw it to you, and then you can kind of show how the programs are designed.
Sure, let's do it.
Good. So second component is cash value. So if you can imagine, basically your life, if your life insurance costs $1,000, you can put $4,000 or $3,000 in your policy, but you're doing what's called overfunding it. And that overfunding exists or resides in what's called cash value. The technical name is called paid up additions. So paid up additions really can overfund by 3 to 10 times. Those paid up additions buy additional life insurance. But here's a kicker. Inside your contract with the insurance company, those paid up additions have a guaranteed dividend of between 4 and 6%. So there's a contractual guarantee. And then because you're part owner in that mutual company, there's a dividend that you get, a dividend that's associated with their profit every year. And so it ranges between 4 and 6%, but it compounds uninterrupted for life. Most people don't understand what that means. So I'm going to try to highlight it here in a little bit. The interest is greater than your cost of insurance by year 3. Your cash in, cash out whole by year 7, meaning everything that you put in, you have available to use. All the growth is tax advantaged. Basically, I'll talk about how you withdraw the money, or you borrow the money, not withdraw the money, how you never ever create a taxable event, right?
It's very similar to like a Roth IRA.
Right.
Where as long as it's used correctly, there'll be no taxable event.
So let's talk about just the value of not having a taxable event. Linz, do you have that poll? Can we do a quick poll on taxes going up or down?
I sure can. Here you go.
So here's a little poll we have. So we want you to take it. Do you believe that in our current debt cycle, do you believe taxes are going to go up or down? Let me know when you're.
Yeah, we'll
ready.
give it just a second here. We've got a couple more people to vote.
I've got a feeling we're probably all or mostly all going to be on the same page here. Especially we've been asking this poll for a while as well, but
But now it's pretty obvious.
Yeah.
Because it's actually a stated goal of the current administration.
Yeah.
So.
Yeah.
All
I think
right.
it's going to go up pretty soon.
So the results are in.
Pretty much everybody's going up, right?
Yeah, are you guys able to see it or no?
Yeah.
Okay.
I can see it on the computer. Yeah. So 100%.
Yep.
So
Okay.
now you understand the magnitude of putting your money, your hard-earned profits inside of a vehicle that grows tax advantaged, or in the right language is never creates a taxable event when you use the money. So then the question is, well, then how the heck do I get my money out, right? And so you can see that the insurance company has a lending arm, not a withdrawal arm, a lending arm. And the insurance company says, hey, you have all this money over here stored in cash value. So I'll tell you what I'll do. I'll loan you up to 95% of your cash value at a variable rate of 3.5% or a fixed rate of 5%. So what that means is when I'm using my money, it's actually not a withdrawal. So it continues to compound over here between 4 and 6%. And it costs 3.5%, but Jonathan's going to review what happens when you pay down your base. It's a lot less than 3.5%. And so you make the spread. So you're storing up, you're creating a a tax advantaged disposition. You're using your money without using your money, and you're making a spread, a positive interest rate in the middle. And so, and then that interest that you're paying is actually deductible if you're using it for business. And so what I'd like to do is pop over to Jonathan, and he's going to do a little whiteboard experience for you.
Yeah, if you know me by now, I learn on the whiteboard. So I know some of you probably do as well. So I wanted to give you kind of that same breakdown, but how this actually practically works. The reason being, like, if you can capture this part, I think the rest of what Stan's going to share is going to make a lot more sense. So I just want to break it down again one more time. So when it comes to whole life insurance, you obviously pay a premium. There's a cash value and there's death benefit. Unlike term, obviously there's just a death benefit. Term is a if insurance. If you die during the term, your beneficiary gets money. Whole life is a when insurance, because you are going to die.
And it's also an and insurance.
And yeah, for real, because we are going to use it along the way.
Right.
So I'm going to talk about that a little bit as well. But for the sake of just a hypothetical scenario, I'm not talking about a specific age or health rating or anything like that. We're just going to give you some of the basics of how this works. So your premium is made up of two things: the base premium and the paid up additions, as Stan mentioned. So think of it like this. Base is going to decide your initial death benefit, and PUAs or paid up additions, that's going to go straight to cash value. And our goal is to get money into cash value. Why? Because that's what we're going to be able to use along the way. And I'm going to show you how we're going to even use this system to create positive arbitrage. So let's just give an example here. Total hypothetical. Let's just say if you're paying in $100,000 a year in premium into a policy. Now, just so you know, some of you, that may freak you out, some of it may not. You can do anything from, $5,000 a year to 1.75 million. That's, I think, the highest policy we're doing right now a year. So there's a large range based on where you're at. But just to give you an example, and I like nice round numbers, so 100,000, your cash value in your first year would probably be somewhere around 80K. Let's just call it there. And I know, let's give yourself a $5 million death benefit with that. Well, like Stan mentioned, usually by year 2 or year 3, you're going to be cash flow positive. So that means, okay, you pay in 100,000 and your cash value is going to go up by about 100,000. So what that tells me is, in this year, the growth of your cash value, so what he mentioned before, so we got that 4% guaranteed, has overcome the cost of insurance. So this early on, it's not going to grow by net 4%. It's just going to grow by, maybe it's only a very small amount or break even. But it means this overcame your cost of insurance. By year 3, let's skip down to year 5. Let's say you put in 100,000 and maybe this grows by 120,000 that year, whatever that number is. So that's what we're going to see for the rest of your life. The policy, every dollar you pay in premium, more than that will go to your cash value. And your cash value, this is the amount that's accessible along the way. Kind of think of this as the part of your death benefit that's available while you're living. And your death benefit increases each year too. Maybe this year, it's now 5.5 million, etc. We'll just keep growing. Handwriting, awesome, by the way. Okay, so let's skip to year 10. I'm going to do it right here in the middle. Give myself some space. Say year 10. And let's just say, for easy math, you've got, let's call it $1.2 million in cash value. Okay? So if you want to use this money, like Stan mentioned, you don't do a withdrawal from it, you do a loan against it. So you're using your cash value as collateral and taking a loan. And so the way that we've got it worked at the moment is, if you wanted to, again, easy numbers, let's say we're going to borrow $1 million. $1 million, you're going to take a loan. What that means is there's an expense. So current interest rates are 3.5%. on this cash value line of credit. I mean, the cool thing is there's no credit score, there's no origination fees, there's no hassle. You can actually get a checkbook. Like Stan, you've got a checkbook, right? For each 2 checkbooks. Yeah. So he can literally write a check from his policy and give it to somebody, and he'll create this loan at 3.5%. So that's, I mean, part of the argument against whole life is, why would you pay interest on your own money? It doesn't make sense. And the reason is, even though you're using this money, the entire amount still keeps earning. So let's just say, what's 3.5% of $1 million? 35 grand?
Yep.
Need Stan to check my math. Okay, $35,000 a year would be your interest expense. And that's assuming you're not making any payments back, right? So if you, because let's just say over 10 years, you didn't make any payments back on that $1 million. So you still got $1 million loan. You would have paid 350,000. If you made payments back, so let's say you just put yourself on a 10-year AM and we're making monthly payments back, your actual interest expense, I'm going to do an estimate, but it's going to be somewhere probably around 180,000.
Yeah, I mean, it's going to be half of 3.5 because you're
Close enough, yeah.
Because every time you pay down the principal, your interest calculation is on a lower number.
Exactly.
And the opposite is true on the insurance side. It's continuing to compound up, right?
And then let's also remember that this is a tax deduction if you're using it for business. So your actual expense, even if it's 350,000, if you've been deducting that from your taxes, that's probably more like what, 200K? Or if you've been making payments back, let's just call it 100K. So your expense over this 10 years of using the $1 million, depending on whether you're paying it back or not, it's going to be somewhere in that $100,000 to $200,000 range. Hopefully that makes sense. So your expense was 100 to 200 grand using that $1 million over 10 years. Positive arbitrage is this. You have an expense, but you've also got a gain at the same time on the same dollar. So this 1.2 million over this side was earning. So let's call it a net 4%. Say it's policy that's 10 years in, you're probably netting somewhere around 4%. So 4% of 1.2 million, what's that, 48,000?
Yep.
And instead, the opposite happens. When you pay down a loan, the interest gets less each year. When you've got compounding interest towards you, it gets more each year. So year one, it's 4% of 1.2 million, which is 48,000. So year two, it's 4% of 1.248 million. Hopefully that makes sense. So it's going to start compounding towards you. So over this same 10-year period, it's actually going to grow by probably, I'd have, again, depends on age and health, but in this example, it's going to be around 480. So it's probably going to be around $750,000. So again, you use the million. So rather than taking it out of your bank account at Wells Fargo or Chase, where you earn nothing when it's in, you earn nothing when it's out. In this scenario, you use the money, you went and invested it, and you bought a business, did some real estate deal. At the same time, it cost you 100 to 200,000, and it earned you 750,000 with no taxable event. And now you can use this money to go do another deal. So that's the why. That's the big why of like, if you can set up this kind of vehicle, especially for your business, but for your family as well, having that kind of a spread while getting to use the money and still go do investments is a really powerful vehicle. Mm-hmm. And so that's what we've been doing here at Unbridled.
So the answer to the question is, why would I pay interest on money to borrow my own money?
Yeah.
And the answer is because you got a reciprocal add on the other side.
Yeah.
That far out exceeds what you're paying.
Yeah.
And what you're paying is deductible.
Yeah.
Right.
Yeah, you get a tax deduction here and tax-free or tax advantage gains over here. And we didn't even mention the death benefit because this is a whole life policy. So the death benefit on this by then is probably $8, $9, $10 million, again, depending on the person's age.
Right. So the death benefit. So I think what we are really careful to say is we're teaching a banking system.
Yeah.
The death benefit's just like gravy
cherry on top. Yeah.
Even if you didn't have the death benefit, you would want to do this.
Yeah.
Right.
Mm-hmm.
Because every dollar you spend, you're making interest on it.
Yeah.
And you do it right.
You don't have the term insurance expense along the way. So you got a cost savings there. You got the long-term care benefit built into that.
Yeah.
So for those who say buy term, invest difference, that's why we're like, or do this system, still do the investments, don't have the term insurance costs, and get the lifetime death benefit.
So we say buy a whole life and invest
the cash value. Exactly right. Yeah.
Because at least if you die and you made a bad mistake investing,
you got all your money back anyway. Yeah. That's actually, okay, so one last quick point on this loan. So I often get asked what happens if you never pay back the loan. So that $1 million, if you never paid it back, then when you die, let's say it was a $10 million death benefit, it'd pay off the $1 million and your beneficiary would get the net amount. So in this case, $9 million.
Yeah. So in our case, we say there's common knowledge, what they want you to know, which is what most of the capitalists are doing in the market, and credit cards and all that. And then there's uncommon knowledge, what they don't want you to see. And so we're suggesting the power of uninterrupted compounding, multitasking dollar, what happens when you dynamic flow your money, and then how you create financial velocity with it. So I'm going to restate this. So we'll go through this really quick. So this is that same $100,000 example, right? You've got $25,000 cost of insurance, 75,000 PUA. We're going to overfund it for 5 years. We've talked about all that. So here's what's happening inside the policy. In year one, we put 100,000 in, and then within 2 weeks, you have access to 75,000.
2 days.
I know, but
Sure.
right?
Yeah.
2 weeks. You could get it faster. So the actual net cost of this is less than 25,000 to get your bank set up. Now look what happens in year two. I put another 100,000 in, and it grew 101,000. By year 5 and 6, so you can see in year 5, we've overfunded it for 5 years, but year 6, we're only putting the 25,000 worth of cost of insurance in there. So by year 6, my total out of pocket is 525, and I have $532,000 in cash value. So the language that we use is, in year 2, this is cash in, cash flowing positive, and in year 6, it's cash in, cash out whole.
Yeah.
And from there, it's always growing. So when you get out here to year 30, you can see that I put $1.2 million of cash into my banking system, and it's grown to 2.7 million. All the while I have access to that cash to use it to make other investments. I'm going to show you some really, really specific examples of that.
And look how much that's growing from year 30 to year 31 as well.
That's right.
You're paying in, what, 25,000?
Yeah, putting in 25,000, it's growing 170,000.
Yeah.
174,000 or 6,000, right?
Yeah.
Probably do the math on that someday.
Yeah.
And your bank over here, your lending institution inside your insurance company, or we have something that are external, says, hey, I'll loan you that, whatever, however much you want. No questions asked, right? It's unstructured. You can have it as fast as you want. I'll give you a checkbook. And so this is the real summary of the compounding interest. By year 2, every dollar I put in grew 1%, 101%. By year 5, it's 110%. By year 10, it's 203%. By year 20, it's 383%. By year 30, by year 30, when I put $1 into this account, it's going to grow by $6.33. And so we often get, well, I could make that return in the market. And I'm like, I would actually.
Not if it's 2008.
Not if it's 2008. Right. So does that make sense? And look what happens to the death benefit all along. Year 5, when we're getting cash in, cash out whole. And now it started at 3.9 million. Now it's 8 million. And by year 30, it's $9 million. All inside of this idea of uninterrupted compounding. When you put $1 in the traditional bank, there's a thing called fractional reserve lending. They can loan that same dollar out 11 times. And so when I was kind of discovering all this, I was like, well, that's like $1 multitasking. And could that same be true inside of a whole life policy? And you can see, this is the real estate example. Real estate's smart because $1 in real estate works for you at least 4 different ways. You get the increase in equity, meaning you're buying down your mortgage, increase in market value, interest deduction, and if it's a rental property, you should be getting profit from operations or depreciation, right? So $1 in real estate works for you 4 different ways. That's good economics, right? When you take that same mortgage payment and you drop it into a whole life, you drop it in, insurance carrier, and you take it back out to pay your mortgage, it works for you by giving you a death benefit, creates the uninterrupted compounding process, creates financial velocity, tax advantage wealth transfer, unstructured policy loans, creditor protected, chronic or terminal illness, and disability waiver of premium, which basically means if something happened to you, the policy will continue to make your base payment. So $1 in real estate with IBC behind it works for you 12 different ways. It's going to be 12 different places at the same time.
Yeah. I mean, within real estate, it's brilliant. That's why we do. We actually did a webinar last week on just specifically using this in the context of real estate investing.
Yep. So I'm going to give you a real estate example that hopefully will blow your mind. So when you look at the common knowledge says, I have a business, I got to, make some income, we've got expenses, we make some profit, retention, retained earnings, and then I'll make my investments. But in our world, if you knew the money was going to be there, because that's the thing about business, you have to have the cash flow when you need it, right? So you can't put it in the market, you can't put it in CDs, you can't put it in a whole life and borrow from yourself. And so what we're suggesting is that you're actually moving your capital into the banking system earlier before you pay your expenses.
Well, you put it at Wells Fargo and 0.01%.
Right.
And that's another good option for you.
And pay 11% for the line of credit.
And then pay taxes on those gains.
And then have no exit strategy, right?
Exactly.
And so when you do this, you're basically turbocharging it because you can put more in when you know that you have access to that cash. And inside your banking system, you get life insurance, the cash values, the uninterrupted compounding, the self-directed liquidity, the guaranteed returns, and the wealth transfer. So again, common knowledge says that I either have to borrow money and my whole goal is to pay it back to get back to zero. Or if I'm a little fearful of that, I can save and get back to zero. And so that whole goal, the way the world wants you to see it is, the whole goal is to get back to zero, to get everything paid off, right? The wealth creator understands the key is never give up your basis. So if I never give up my basis, I'm pushing as much through as I can. I actually can't get more life insurance, right? Because everything I found, I keep pushing it in there and like, let's just funnel it through this, because the compounding of the 4 to 6% is so powerful down the road.
What's your total premium a year? Do you know?
$2.5 million.
2.5.
Yeah. Yeah. So, so this is the example. So here's IBC versus term insurance. So the world says, hey, term insurance is cheaper. It is until it isn't. And they're like, whole life is too expensive, right? Same basically policy structure. You can see this whole life product. Yes, it costs you a little bit in year 1, 2. Year 3, it's cash flow positive. Year 5, so this is when you stop paying for your death benefit, right? Year 5 to 6, it's cash in, cash out whole. And so by year 15, your whole life policy has a guaranteed return of $188,000 with dividends projected at $340, and your term policy would have cost you $141,000. And here's the funny thing about term insurance. You can't use it. The only way to get it is to die.
Yeah.
Right? Here, I have all this power of capital that I can mobilize, and so most people, so let's do another poll. The poll, what's the question, Linz? Do you have it?
What percentage of term policies never pay out?
So what percentage of term policies never pay out? Meaning what percentage are abandoned and actually never come to materialization or paid out?
Give it just another second.
And it may sound like we're just ragging on term insurance, but term insurance is, I think it's a necessary evil, right? It's like car insurance. You got to have it
to get more whole life.
Right. But it's the mentality or like the predominant saying of like buy term, invest difference. I think we're really trying to hammer of like, there's this common knowledge, I'd call it, or just like you've assumed it because you heard your dad or some guy say it on a blog online of like, no, whole life's just expensive term. We should do this. And so that's really why we're giving term insurance such a hard time.
So the results are published, right? I'm going to take.
Yep, there you go.
50% said 87%, 13% said 57%, 38% said 97%, and the right answer is 97% now. So, like, wrap that around your head.
Yeah.
I'm buying something that costs me my death, and I bail on it 97% of the time.
97 is actually pretty generous.
Yeah,
it's pretty close to 99% doesn't pay out.
So the insurance companies are really incentivized because it's pure profit.
Yeah.
Right. And so Would you rather do that or have a guarantee
Yeah.
of 188,000 plus a $4 million death benefit?
Yeah.
So that's why we're so passionate about it, because there's a lot of misinformation about this stuff. And when you go online, you read a bunch of junk about it, and we're like, the numbers don't lie. Your contracts don't lie. So the summary is you finance everything. You either pay interest to someone else in the form of the debtor, or you give up interest you could have earned somewhere else in the form of the saver. There's no exception. All right, you ready for some case studies? Are there any questions you want to cycle through, Jonathan?
No, I don't think so right now, but that's a good reminder that I know we're still just kind of in the basics of it, and so we're going to get into case studies. But as questions come up, either just shoot them to us directly or in the chat with everybody, and we'll either address them as we go, or we got some time at the end as well. But I'd say just jump into the case study.
First case study is our office space. Okay. I own the Grant Street mansion, and this is it on 11th and Grant. We restored it, and we rent from ourselves. So Unbridled Solutions rents from a company I own the Grant Street mansion, and they pay $540,000 a year in rent. So I'm on both sides of these transactions, right? Different partners here. So this mansion has a $400,000 a year mortgage, right? And in 20 years, theoretically, if all goes well, I'll have a $6 million asset. It'll be worth more than that in 20 years, especially if inflation hits, right? And I'll have taxable income of the rent. And let's say there's a little bit of appreciation in the rent. It goes from 540 to 600. So 20 years later, that's kind of the typical thing. Your money's going to work for you 4 ways. But instead of paying the mortgage here, I'm dumping the mortgage into my life insurance. Now, the problem with the life insurance, or the hurdle for the first year, is the cost of the insurance, right? Which in this policy is $108,000 a year. So you can see that I have about $282,000 worth of cash value. So I've got to make up the gap between the $282,000 and the $400,000.
And this was this policy was 5 years ago.
Yeah, they're way more efficient now.
And so, yeah, even now it's like you
Yeah.
get 80, 85% sometimes cash
Yeah.
value year one. And so
Yep.
this was back when we could only get, 70%
Yep.
maybe.
So just by changing the flow, the dynamic flow of equity, look what happens down here. In 20 years, watch this. I added 556,000 of additional tax-free income and a $20 million death benefit. All I did, and what I want to say is these numbers are big because of the size of the real estate, but the macroeconomics of it, the way they're overfunded and all that are all the same. So the multiples will generally be the same. And so you can see by changing the flow, I went from $600,000 of taxable income to 1.2 million essentially with a $20 million death benefit.
And in 20 years, that tax deduction or that tax reduction is going to be pretty significant.
Yeah, that's right. So this is an illustration that you get, and so this is the illustration on the Ohio National is the company that's carrying this. You can see the policies on my wife. Why? Because she doesn't have the belly that I have, and so she's age 49, super preferred. Death benefit $7.7 million, policy premium $400,000, and we're going to do that for 10 years. Why? Because I'm going to be committed to this building. It's a buy and hold strategy. Why? It's not so much the value of the real estate; it's the value of the policy behind the real estate.
Yeah,
that's creating all that, right? So here's what's important. You'll get an illustration just like this. In year one, I put in 400,000. I have cash value of 282. So the surrender, I was negative 117, which was essentially the cost of the insurance. Year two, put another 400,000, cash value bumped up to 581. By the way, these are usable right away. Death benefit bumped up, surrender value, not as big of a hole, but still a big hole. Year three, now it's going the trend reversed, right? So now all of a sudden it's cash flow positive. By year 6, I put 2.4 million in it, cycled in and out. For every 400,000, it's growing 500,000. I've got all my money available and I created a $13 million death benefit. So at that point, it stops being about the real estate and more about how am I going to leave this to the next generation? Because inside of this, for every, in year 59, I put in
age 59.
Age 59. I put in 400,000 and it grew to 588. So 188,000 increase. And so there's a yield curve, there's an exponential yield curve that happens on all these. And so the yield curve on this is the day you stop overfunding. So year 11, I stopped overfunding. I'm only paying for my base premium. My base premium is 108,000. I put in 108,000, it grew 349,000. Right now so what's it? I'm 10 years of, let me go back. I'm 10 years at 400,000, so 4 million, 4.1 million, and it's worth 4.9 million. Here's my surrender value. It's grown 800,000 in that 10 year, in that 11th year. And the death benefit's at 16 million. So now we got to address the other thing, right? The other thing is this part right here is all of the life insurance policy. The cost of capital is me borrowing it to pay the mortgage, right?
Yeah, and we did that at 4.4%
right.
for the interest, which now we're at 3.5%.
Right.
And the Fed recently announced that they're not going to raise rates for another 2 years.
Yeah. And the truth is, because of the other businesses, I never actually touched this cash value. I never borrowed it because I basically settled up with the company.
Yes.
I paid them interest.
Yeah.
Right. And I paid them interest of 2%. They prepaid for the year, and then I used that. And so, but the moral here is, you're going to draw, and by year 15, you're starting to really make real money in your mortgage. By year 20, you're starting to make real money, but by year 20 is when you stop paying the mortgage company through your whole life, right? So then the next few payments you're making back to pay off your loan. So you're entirely paid back by year 25. And so now if you look at year 30 to 31, which is probably, if statistics are right, when I'm going to be close to expiring, your policy's growing. You've got a net gain of $8 million, but your policy's growing $700,000 a year. For every 100,000 I put in, it's growing 700,000 in a tax advantage way because you're never withdrawing it, right?
Yeah, and so like with this, you'd have a $15 million base that's growing by that much. So you could comfortably pull out $50,000 a month for the rest of your life without paying any taxes and leave behind tens of millions of dollars.
Yeah. Right.
Or you could, cool strategy.
That's right. Or you buy a house for your grandkids and never pay it off.
Yep.
Right. Because when you die, there's 25 million that you have to transfer, which I'm going to deal with here in a little bit, how this helps you transfer your. I keep looking down here because the TV's down there. I should be looking up at the camera. So Albert Einstein had it right. He said, compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it, right? All right. Ready for the next example?
Yep.
This is what we call adjacent opportunity. And so there's a couple slides here. So one, we have this event planning company, and I highly encourage that you do this. We started charting, we do corporate events, we do production, there's association events, there's experiential marketing. And so we bubble all these things out to decide, where our new frontier could be. And you isolate them core, adjacent, advantageous, or inopportune. And so this is the example of when COVID hit, because we've been storing up 1/5 of our profits for the last 20 years inside of our company and putting it into whole life. We had this reservoir of, $1.5 million roughly in cash. And so when COVID hit, we didn't have to flip out. We looked at this and said, well, what's the customer saying? Well, the customer's saying video, event content, web dev, virtual events, custom apps. And so what we did is we pivoted the whole company using the adjacent opportunity model and our cash value to write a virtual platform. And from June of last year till now, we've done over 150 virtual events largest audience 10,000, smallest like 50. And so so you can see that this IBC lurking behind the scenes can allow you to move in new territory really quickly. And so so here's a supercharged version. So this is how we look at everything. So adjacent opportunity. We already did this example. So this company rents the mansion. So Jonathan, this is one source of income, right? The mansion is the second source of income, same pipeline. When this company pays distributions, we put those distributions in a personal life insurance policy so that it can take advantage of the uninterrupted growth. So it's 1, 2, 3 forms of income. Okay. Now, we knew we were going to buy a lot of these whole life policies. So we thought we should be experts. And Jonathan and I created a relationship. So we started Unbridled Wealth to be experts at this. So that's the fourth source of income. And inside of Unbridled Wealth, we created the policy that's a fifth source of income, right? Then we knew that we were going to remodel the mansion because it was really bad. It's going to cost roughly 1.9 million. And at best case scenario, 190,000 would go to a contractor. And so instead of doing that, we decided to start our own construction company. And we did that 2 ways. One, we gave them this contract, 190,000, and we took a loan out of my personal policy to put inside the construction company. And they paid the policy back at 6%. And when the $100,000 loan was paid back, we went from majority share to minority share. And so this whole experience right here was entirely self-funded.
Yeah.
Right.
And super generous to those partners because they get immediate revenue. They get the funding.
Shared services.
It's a flexible loan payment. You win. Like it's truly a win-win scenario.
So we had a company like that went, didn't go so well and ran through $250,000 really fast and looked like they were going to go out of business. But because I'm the owner of the policy and we're the owner of the structure of the policy, what we did is we converted it to interest only for 6 months, let them get back on their feet until they could pay it back, and ultimately sold it back to them. And so where we, how many forms of income we were?
6.
6. So this is 7, right?
Uh-huh.
And then Jonathan figures out that there's tax credits on available in these historic mansions. And so there was $920,000 worth of tax credits that we applied for and got. We used those tax credits to buy the mansion that we're broadcasting from today. So it's 10 forms off the same pipeline. One company, 2 life insurance policies, a loan structure, tax credits, real estate. And that's what we're saying. If you do that, you can understand the value of adjacent opportunity and the value. I mean, this loan is no risk because it has this giant death benefit. So if they go bankrupt, you just never pay it off.
Yeah.
You just wait it out. So then we were finishing this mansion and we were looking for the next opportunity, and Canyon City found us. Canyon City, Colorado. Here's some pictures. And so we're talking about restoring people and restoring places and restoring old buildings. And so this hotel in 2018 in the summer went on auction. Jonathan went down and out of kind of a fluke of circumstance, he buys it for $88,000.
It was a live auction with not much attendance.
But think about it. You didn't need to ask anybody for money.
No.
You went down there with a check, and it was a must sell, right? And you came back having purchased a hotel, right? So that's 30,000 square feet. So what's 30? It's like $5 a foot, $4 a foot.
Yeah.
Right. And
not
so
even, yeah.
right. And so we're working on restoring that. Well, then we realized that we would need suites. And so because we had cash, we bought the St. Francis Cabrini right down the street for roughly $100,000. Then we realized we needed parking. So we worked with the guys next door here's the hotels right here. Then we realized we needed a meeting space. So we were able to buy this building next door to this. Then we wanted to do entertaining in a restaurant. So 2 doors down, we purchased the annex building, and the top of the annex building has one of those old school ballrooms. And then the post office, we purchased and turned that into event hall. And then we purchased the last building for our corporate offices. And so all of that real estate, because we were at the right time and we had access to the cash, was under $1.6 million. Then guess what we did? For the properties that we wanted to renovate a little bit, we flipped and we went to banks and we mortgaged them. Paid cash.
Cashed out, refinance.
Cashed out, refinance. So we cashed out, refinanced the Apex, the post office, the annex, and these are all we paid cash for.
Yeah.
Right. And these are all on 15-year terms. And then we took the money back out and put it back in the whole life policy. And so that's the value of adjacent opportunity and having access to your own cash that fast.
Yeah, and it's great negotiating with banks when you have all your properties paid off.
Yeah.
It's a lot harder when you're trying to buy it.
Yeah, somehow that's just like, yeah. They're like, oh, you own it? So you don't need to put your income. You're just like, okay. Yep. So what we're saying is you either use velocity or you lose velocity. All right, now we're going to get in the complicated one.
This is definitely my favorite. So this is new content as well, because you know, this is something we've been talking about for years, but this is really the first time we found a partner that's been able to help us with the estate planning and business succession. And it was awesome because when I first met him, Rod, he was like, I started talking to him about estate planning, and he said, I said to him, I was like, are you familiar with the infinite banking concept? And he goes, oh, I love IBC. I put my kids through college using IBC. And I was like, you're our guy.
Yeah.
So the last few months, we've been spending a lot of time on the whiteboard with him discussing how can business succession work? And especially, I mean, for Stan, for you, with 20-something companies.
23 tax returns.
I don't know how many business partners there are across those.
Yeah.
But creating a win-win for your business partners as well as your family and your trust, all of that. And so I'm excited for this. So take us slowly through it.
Okay.
It's complicated.
All right. So the supposition is what we're solving for is a transfer of wealth, right? And we're trying to, so the common knowledge says, I got to build my company, create a liquidity event, sell to a big company, take my money off the table, and then retire. And ours is, no, you want to buy and hold until you die, and then allow the death benefit to liquidate or transfer wealth into it. So this company, here's the net effect of COVID. In 2019, this company did 89 million. And in 2020, it did 47 million. So that's the net effect of that business. And, you know,
Still a lot of money,
COVID,
but
right.
a lot of loss right there.
Its net income is about 747,000. Distribution method, every company we touch is the 20-20-60, which we talked about before. Currently, we own 61%. We have 4 managing partners that own 20%. We have a silent partner that owns 19%. This was the person that first believed. Best check I write every year.
Yeah, best investment you ever did as well.
Well, because they wrote a check when no one believed.
Yeah.
And
even her initial investment, every year she gets
more I
than
pay her more than that. So
awesome.
For 20 years.
Yeah.
For 10 years. The valuation method, I mean, these are variable, right? In our business, hospitality, it's about 5 times a 5-year average of EBITDA, which extrapolates at the value per share, 66,000. And when I die, we want to hold 19% in what's called a family office, an investment office. That's the succession plan for my kids, running the family office, right? And I want to transfer everything of the 61% into the 4 managing partners and let them run with the business, right? Silent partner, we're going to keep the same. So we're liquidating 42% of the shares. 42 shares times this comes out to 2.7 million. So that's the baseline we're working with, 2.7 million. Think about that. That's the 20 years work. Like, that's not a lot of money, 20 years work if you were going to divest.
Yeah.
Here's the balance sheet. You can see the company has a lot of cash, and you can see right here, the 1.4 million is the retained earnings of 20% that we've been holding back all these years, right? And so I'm going to compare the traditional buy-sell versus an IBC powered buy sell. So traditional is we've got to liquidate 2.7 million. So we establish the value, we have that. Then we determine, does the company have enough cash, or what do they need for working capital, or do they need to take a note, right?
Yeah.
So we just did some like quick thing. We basically said we're going to pull $1 million out of retained earnings, use that to put down, and then the partners would have to bank finance the 1.7 million, right? 1.8 million. And because that's probably going to be a 6% return, after 10 years, their cost of buyout is going to be 3.3 million. So the summary of that is retained earnings went from $1.4 million to 462,000 because we took it out. There were zero charitable contributions. The total amount financed by the members is 2.3 million, and the deceased estate, our estate, got 2.7, 2.8 million. Okay.
So just recap that again. Okay, so the 4 managing partners are buying out your estate, your trust, your family,
right,
for the 2.7 million, 2.8 million. But there's only $1 million of cash in the business, so they're having to go down to a bank.
That's right.
Fill applications, pay origination fees, pay interest over 10 years.
Yeah.
It cost them 2.4 million.
Right.
They lost $1 million of retained earnings.
Yep.
And that's
And one of the I think in these models, one of the tragic things for me is that sometimes the managing partners get screwed because they have to go get money, and they have to, they helped, these guys have been with us 15, 18 years. So they have to rebuild that, and there's no exit for them, or I want to be able to actually gift the company to them as a thank you, right?
Yeah, well, and also then you think of like, I remember when we were talking about this the first time, I knew somebody who had passed away, and his spouse took over the business, fired the CEO, who was one of the partners, made herself the CEO, and ran
phantom partner that you didn't know
ran the company into the ground. So without a funded buy sell and this agreement in place, you could become the business partner of somebody.
Right.
You may not even know who that's going to be.
And you could have built that company for 18 years, and then you're being dictated by the spouse that you never really got to know. Right? Okay, so here's the IBC version. So you can see here, we still have the same equity, right? But we're actually, instead of leaving it up in cash, we're putting it into cash value life insurance down here. So these two are usually,
and this is what you've actually done, right?
Yeah, these two this will catch up to this because we're at the beginning of the year and the interest continues to accrue, right?
Yeah.
So by the end of the year, these two will be pretty close to each other. Okay, so all we're doing is changing the flow of money, like we've been talking about, and using. So we're here. So the point here is like it doesn't take that long. We're in year 4 of this policy. So in year 4, we've put 1.6 million in. It's going to be worth 1.4 by the end of the year. We have access to that cash, and it created an $8.8 million death benefit. So tomorrow I go out, I get hit by a truck, I'm gone, right?
What happens? But
right. And so, or here's another example. Let's say at 62, I find another hobby, and I'm like, hey, can you guys? I don't want to die to give the company to you. Do you want to just have it?
You can
take
$3 million
$3 million of cash value.
That's right.
And a $10 million death benefit is leverage to talk about. Yeah. But I'm going to say I got hit by a truck.
It could be, hey, Stan, you take this policy and we take the company.
Yeah.
Everybody wins.
And all I want is payout is for you to make my premium every year. Why? Because every time that you make the 123,000, it grows by 252?
Yep, 252.
So, right, you guys pay the premium. I'll exit the company. I'll go to 19%, and I'll make the spread. But when it gets more and more later in your life, as it compounds more, it gets much more powerful. So now you're, by year 80, they put in 123,000, and it's growing 500,000.
Yeah, almost.
Right. Okay, so this is the brilliance of. Can I use the law firm name?
Yeah, sure.
People
to use them.
Yeah.
It's awesome.
All right. So here's the liquidation process. There's a liquidation process because I just died. Instead of this just going to our family and creating a taxable event, we've made the beneficiary the unbridled trust. Okay? So all of a sudden, the unbridled trust gets what? An $8.8 million death benefit. And inside the trust, there is, of course, an executor and all that. But there's a flow, there's a process. And this is the process. First thing the trust does is it says, hey, Unbridled Solutions, you put $1.6 million of cash to overfund the project, the policy, we're going to return that to you. So the trust returns the premium.
That equity that was being held in retained earnings goes cash value and then goes back to retained earnings.
Gives it right back to them. Now you have a net distributable amount of 7.2 million. Keep in mind that technically my estate would own 61% of that, but I don't want to be greedy. I want to turn the business over to them and give them a good shot at moving forward. So net distributable 7.2. We established the company value. We already know that. It's 2.7 million. So we pay the deceased estate 2.7 million and subtract that from the 7.2 and you're at 4.4. Okay. But now, because I'm technically entitled to 61% of this, we need to square that up. And so we pay the deceased estate an additional sum, which is 42% of this remaining amount.
Because you just dropped down that 42%.
Because I just dropped, so you're just squaring it up, you're making it.
Right.
So the deceased estate gets another 1.8 million. And then we distribute the remaining balance according to 20/20/60. So just to re-summarize, death benefit 8.8, return premium of 1.6, cash out the deceased estate. The kicker goes to the deceased estate to square up the extra percentage. The balance is 2.5 million. It gets distributed to the partners. 20% goes to charity, 20% stays in the company, and the partners split $1.5 million. So now look at the liquidation summary. Your retained earnings went from 1.4 to 1.9. You were $500,000 to give to charity to help people.
Which is a tax deduction.
Yeah. Additional distribution to members, of which I would still own 19%, right?
Yep.
And then the deceased estate got 4.6 million instead of 2.7 million. It's still not 61% of this, but it's a really good deal for all the partners.
Yeah.
Which is what you want to do.
Really good deal for everybody.
Right. Took me a while to wrap my head around that, but so here they are side by side. So the question is, would you rather leave your company with retained earnings of 400,000, nothing for charity, your partner's drawing 2.3 million in bank financing for you to get 2.7 million? Or would you rather run this through IBC where your retained earnings grew by $500,000, your charitable contributions are at $500,000, there's additional distributions of 1.5 to say thank you for the partners that gave you this in the first place, and then the deceased estate gets another 2 million, right?
That's pretty awesome.
100% all we did is change the flow of money. Did it cost us a thing?
And you had
It didn't cost us
access to
anything.
the money the
The whole
entire
time,
time.
right? It's just been sitting in my balance sheet.
Yeah.
And and you're not paying tax on it.
Yeah.
Right. So what we say is, what gets us in trouble is not what we don't know, it's what we know for sure that just ain't so. So our opinion is the old model of buy my company, create a liquidation event and sell it, build up the profits, right? And sell it to someone who has to cut it to get the ROI back. You can build the entire thing right in the context of your IBC. We get this question a lot, sources and uses, and then do we have another poll? Lance, do we have another poll?
I feel like we did, but I don't remember exactly what it was.
We had one that is a little bit more. It's assuming you started with 100,000 and earned the compound interest over.
Oh, let's do that.
Okay.
All
This
right,
one, I want everybody to read it a couple times because it is, so I'll read it. Assuming you started with 100,000 and earned 4% compound annual interest over 50 years, what would be the tax benefit given a 28% tax bracket? So if Jonathan, if you want to give some more context.
Yeah, so, well, actually, no, I don't know this one, so read it again so I can hear it.
Yep. Assuming you started with 100,000 and earned 4% compound annual interest over 50 years, what would be the tax benefit given a 28% tax bracket?
Oh, that's a trick question.
You can't even see the potential answers.
Yeah.
So can I,
Here's
can
your
I spitball
answer.
one?
Go ahead.
I'm going to guess around 200,000. Is that one of the options?
No, so they're
No.
700,000 taxable versus 800,000 untaxed. Yeah, this one's kind of tricky. And so this was actually one of our advisors, Ryan. He's
He's
Of course. Yeah,
Yeah.
Ryan, he makes me feel
Oh, he's gonna get the
so-
answer
yeah.
right. If he just answered that, that's
no,
I'm hoping people got their calculators out.
Yeah.
we'll
Or
give it
how
another
about
minute here.
Jonathan,
Ryan,
do you know what 4% annual compounding $100,000 for 50 years, what you would end up with?
I don't know top of my head. Oh, I know. I did that one before.
Yeah.
It's like 700,000, something like that.
No, it'd be millions.
well, those are all the options. So
well,
100,000 compounding over 30 years.
4% would be like,
Yeah.
it'll be sub a million. It'll be somewhere around 750.
No, I was saying if you put a premium in every year of 100,000.
Oh, gotcha. Yeah. that
go
would
ahead,
be-
Ryan. Do you want to give a little more context to this one?
Yeah, Ryan, talk to us.
Yeah, sorry, I know it's kind of complex. So this is assuming you only had $100,000 starting year one, never put anything else again, right?
Yeah.
So $100,000 you start with, you're assuming it compounds 4% annually for 50 years. And what I'm asking is, what do you think the difference between the ending amount you'd have if you got taxed on the growth versus if you were not taxed on the growth? So I can read the questions. I'm not trying to stump you with what the numbers are, just the difference between the two. So the questions, Lindsay, can you put it up again? Can we see it?
It should
Assuming you
still be up.
started- Yeah, read it again, Lindsay.
Yep. Assuming you started with 100,000 and earned 4% compound annual interest over 50 years, what would be the tax benefit? And so your options are A, 700,000 taxable versus 800,000 untaxed. B, you'd earn 700,000 versus 900,000 untaxed. Last one is, or the third one, 700,000 taxable versus 1 million untaxed. And finally, 710,000 taxable versus 1.6 million
That's a
untaxed.
Great question.
Then I'm going to go with number 4.
I'm going with number 4 too, but you're seeing the value of not paying tax on it.
Right.
So this whole,
All right, so
All right,
I'll go
Ryan,
ahead and
help us
end
out
it so
on
we
this
can
one.
see.
Sorry, I know that was complex. I didn't know how to do it in a.
So we got 4 people who were brave enough to answer,
Yeah.
and we split evenly between all of them. So Ryan, you want to tell us what was the
One
winning?
you paid tax on the gains and the other you didn't.
Yeah.
Along the way.
Mhm.
Okay, gotcha.
Right. So if you paid tax on that 4% every year, then, well, I'm assuming you're not getting tax. You're getting 4%. But if you consider the tax benefit of not having the taxes, then it comes out to like 5.71%, which doesn't sound like a lot. But 4% compounded over 50 years, you'd end up with $710,000. With the taxable benefit making it equivalent to 5.7%, it'd be $1.6 million after 50 years, meaning the difference you saved in taxes on a compound basis was $900,000.
I mean, like, we've been doing this for 11 years and I still get amazed at some of this.
Yeah.
You moved the interest calculation basically
yeah.
by 1.5 points.
Long-term
1.7.
compounding and taxes are just such a big deal.
Yeah.
People don't pay attention to.
It's like, it's uncommon knowledge.
Uh-huh.
We treat everything differently.
Yeah.
By the way, I pay my taxes using whole life.
You did?
Yeah.
That's awesome.
So people will, well, where'd I come up with the money to do it? So this is a source and use. You have business cash flow, personal cash flow, annual bonuses, retained earnings, cash out refis, restructuring your debt, CapExes that you can run through a whole life, operational efficiencies, tax credits, miscellaneous investments, and estates and inheritance. The uses are giving you a guaranteed rate of return, tax-free growth, managed liquidity, control of your banking, real estate, debt consolidation, succession planning, deferred comp, small business investments, college, and estates and inheritance, right?
Well, that's, yeah, it's a pretty flexible vehicle and strategy that you can do a lot with.
Yep. And so I'll go back to where we started. If the American people ever allow private banks to control the issue of their currency, first by inflation. So in my lifetime, George W. Bush, Jimmy Carter actually deflation was George W. Bush, right? The banks will deprive the people of all property until the children wake up homeless on the continent their fathers conquered. The issuing power should be taken from the banks and restored to the people to whom it belongs. And so we want you to be in charge of your own banking system.
Yeah, and I appreciate you reading that because it always feels weird when I read that statement.
Because of the accent,
Yeah.
dual citizenship. So, I mean, that made Thomas Jefferson blush.
Yeah. I know, that was
So,
200 years ago. It's crazy.
All right, so question answer. So what I want to tell you, like, this is very raw information. I mean, these are all actual case studies that we're actually doing. We've got, I don't know, close to 20 banks now because they're running behind the scenes. Yeah.
Yeah, banking system.
Yeah, they're running behind the scenes of these businesses that we're starting and real estate that we're doing. And so it's like a silent partner creating massive amounts of equity in Canyon City. I mean, my dream is to be able to, when I die, pay most of those buildings off.
Yeah.
And then leave a city with a debt-free inheritance, right?
Yeah.
And so, okay, so Jonathan and I are open for Q&A, and then we want to give the switcher a hard time. So some back and forth.
Yeah, Lindsay, could you maybe jump on and ask any questions that come in? And I can even make it so if anybody wants to ask the question themselves, you can raise. I think there's the raise hand feature.